We have Simon Grose-Hodge, investment strategist at LGT Bank, and he joins us on the line from Singapore. Simon, let's talk about the euro at this point. It seems to be on the comeback trail right now with some lights from the EU, possible bailout for Greece. But where do you think the euro will end, say, in the next month or so?
Yeah, hi, Susan. We would, at LGT, we'd definitely be on the side of RBS rather than Citigroup. We don't see any long-term positives for the euro, even if we do get a bailout for Greece. I mean, there's very much a feeling in the market that something is going to have to be done at some point. But the question is, at what price is that going to be done? If the EU do give some sort of a bailout or rescue package, it's going to come at the price of even greater austerity measures that will be demanded, and that is basically going to kill the Greek economy. And when you look further beyond that, you've got Spain and Portugal in a very similar situation. They may well be next up to the trough in terms of wanting money, and then they're going to be forced into even greater austerity. So that means that all of the smaller economies in the EU region, basically their recovery is going to be snuffed out. So even with a bailout package, the longer-term prognosis is for stagnating growth in Europe, the ECB handcuffed in terms of policy and not being able to raise interest rates, and all of those are effectively long-term euro negatives. So we see any bounce in the euro perhaps even as high as 139, 140 because of the weight of short positions that could be squeezed out. We wouldn't advise clients to chase the rally higher. We think it's going to be a selling opportunity, as said, anywhere toward 140. And as said, I would agree with RBS that over the next 2 to 3 months, we're probably looking at a fairly quick test of the 135 lows and then perhaps even down to 131.
Oh, that's interesting, Simon. So what about the U.S. dollar? Because your colleague, Hans Gerty, said back in December that LGT was actually overweight on the USD, at least in the next 2 months or so. And we've seen the dollar index gaining about 2% since then. So does this make the U.S. dollar look more attractive?
Yeah, that's right. We've been bullish on the U.S. dollar, particularly against the developed world and against the European currencies since the end of last year. And we consider that still very much the case. Although the U.S. debt situation is certainly no better than Europe, it's not escalating at the same speed. It's a situation people are very much aware of. And the general perception is that the U.S. economy is much more dynamic. It has much more flexibility in terms of policy. The Fed has got a much more pro-growth stance as well as anti-inflation, whereas the ECB is more of a hardline central bank. So the U.S. economy does have a slightly better outlook, and with risk aversion at somewhat higher levels now than people were expecting a month or so ago, we think the U.S. dollar can fare quite well against those old world currencies, but on a medium-term horizon, we still see it underperforming against the commodity block.
Okay, the commodity block, meaning the Aussie, the CAD at this point. So let's talk about the Australian dollar, because it has dropped, actually, snapping the best rally for this currency in 5 weeks. What do you see for the Aussie? It seems that the parity call is off the table at this point. So I guess in the next few months or so, where are we going to see the AUD?
Well, on a medium-term outlook, we wouldn't necessarily say that parity has been taken off the table. We actually advised clients about a month or so to reduce Aussie positions, as we did see some near-term weakness as we were expecting the RBA to pause in interest rates. However, it is only a pause. They're probably going to restart hiking rates in the second quarter and keep that going at probably 1 rate increase per quarter rather than every meeting. And that still means that their rates are going to be going higher before any of the other major central banks, and that's simply going to widen the interest rate advantage for the Aussie. We don't see a hard landing in terms of the Chinese economy and the amount of tightening there. We think that's been somewhat exaggerated, and China is now very definitely the key driver for the Australian dollar. We see a lot of demand for resources. If you saw recently, China was buying ETFs in oil and gold. That shows that they're avaricious demand for real assets. So we think the medium-term story for the Australian dollar is still very good. We could perhaps dip as low as 84, 85 cents if risk aversion increases in the near term, but we would advise clients to start rebuilding positions at those sort of levels. In a 4 to 6 month horizon, we see it back in the 90s and pushing up towards that parity level by the end of the year.
Okay, Simon, thank you for that. Simon Grose-Hodge of LGT Bank.